Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Albemarle Corporation quarterly report. Albemarle Corporation offers a diverse range of businesses and services across three segments: energy storage, specialties, and Ketjen. The company's energy storage segment provides lithium compounds for use in various applications such as consumer electronics, electric vehicles, power grids, solar panels, high-performance greases, and specialty glass. This includes lithium carbonate, lithium hydroxide, and lithium chloride. In the specialties segment, Albemarle offers bromine-based products including elemental bromine, alkyl bromides, inorganic bromides, and various fine chemicals. The company also provides highly specialized lithium solutions such as butyllithium and lithium aluminum hydride, cesium products for chemical and pharmaceutical industries, and zirconium, barium, and titanium products. The Ketjen segment focuses on clean fuels technologies, including hydroprocessing catalysts, fluidized catalytic cracking catalysts, and performance catalyst solutions. Albemarle serves various industries such as grid storage, automotive, aerospace, conventional energy, electronics, construction, agriculture, food, pharmaceuticals, and medical devices. Overall, Albemarle Corporation's businesses and services span across multiple sectors, providing essential products for various applications. Albemarle Corporation market capitalization of $24 billion is significantly larger than the average industry peer of roughly $4 billion. This shows that Albemarle Corporation holds a significant advantage in their industry. Albemarle Corporation trades at a higher price-to-book ratio of 3.2 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 40% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased, while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of various factors affecting the company's financial performance. Revenue growth is primarily driven by the energy storage segment, which experienced favorable pricing impacts and higher sales volumes due to customer demand. The specialties segment also contributed to revenue growth, with higher sales volumes in flame retardants and favorable pricing impacts. In addition to these segment-specific drivers, the company benefited from the sale of accounts receivable under Master Receivables Purchase Agreements and a grant from the U.S. Department of Energy and Critical Materials award from the U.S. Department of Defense. These external factors contributed significantly to revenue growth. On the other hand, revenue decline was primarily driven by the corporate and all other segment, which experienced lower sales volumes due to divestiture and PCS. The estimated additional charges related to decommissioning costs for Kemerton Train also negatively impacted revenue. Overall, the company's revenue performance is influenced by a combination of internal factors such as pricing and sales volume, as well as external factors like grants and awards. Understanding these drivers is essential for making informed business decisions and predicting future financial outcomes. The net income of the company underwent a significant transformation between 2025 and 2026. The most notable change was a staggering 566% increase from $49,298,000 to $328,977,000. This substantial growth can be attributed to various factors, including a 180% rise in net income from $101,744,000 to $284,664,000, and a 672% jump from $41,000 $348 to $319,091 in the first quarter of each year. The profit margins also witnessed a remarkable shift. The gross profit margin surged from 14.4% in 2025 to 35% in 2026, while the operating profit margin increased from 1.8% to 16.3%. This significant improvement can be seen across different segments, such as energy storage, which saw a rise from 35.4% to 62.1%, and specialties, which grew from 18.3% to 21.2%. The substantial increase in net income and profit margins can be attributed to various factors, including improved operational efficiency, increased revenue, and strategic business decisions. The company's ability to adapt to changing market conditions and capitalize on emerging opportunities has likely contributed to its financial growth. The company's financial performance indicates a strong ability to generate cash from its core operations. A comparison of the net cash provided by operating activities for the years 2025 and 2026 reveals an increase in positive operating cash flow. In 2025, the company generated $547,207 in net cash from operating activities, while in 2026 this figure rose to $346,244. This upward trend suggests that the company is effectively managing its resources and generating sufficient cash to support its operations. The company's debt level and interest expenses have undergone significant changes over the past year. According to the extracted summaries, the long-term debt has decreased substantially from $3.1 billion to $1.8 billion, indicating a reduction of approximately $1.3 billion. This decrease is consistent across multiple pages, suggesting a notable improvement in the company's financial health. However, the interest expenses have shown mixed results. Initially, there was an increase of $12,591, but this was followed by a significant decrease of 32% from -$48,977 to -$33,121. Despite this fluctuation, it appears that the overall trend is towards lower interest expenses, which could be attributed to the reduction in debt levels and improved financial management. The performance of Albemarle Corporation's segments and regions varied in the first quarter of 2026. One notable area of success was energy storage, which saw significant growth with a net income attributable to the company of $319,091 and a percentage of net sales reaching 22.3%. This strong performance suggests that the company's investment in energy storage solutions is paying off. In contrast, the specialties segment did not provide any specific data, making it difficult to assess its performance. Additionally, corporate and all other was not considered a segment, but rather an umbrella category for corporate-related items, PCS business, and Ketjen joint venture, which does not offer a clear picture of its financial standing. The company has a history of paying dividends to its shareholders. In recent years, it has made significant payments to both common and preferred shareholders. On page 39, we see that $47.7 million was paid out in dividends to common shareholders, while an additional $41.7 million went to mandatory convertible preferred shareholders. A closer look at the dividend payments reveals a clear pattern of regular payouts. As noted on page 40, a cash dividend of $0.405 per share was paid out to all shareholders as of record on March 13, 2026. This indicates that the company is committed to returning value to its investors through dividends. It's worth noting that there is no mention of the company buying back shares in the provided information. The focus has been squarely on dividend payments, suggesting that this is a key aspect of the company's strategy for rewarding shareholders. Concerns about inventory buildup or supply chain disruption are evident in the provided summary. On page 9, it is mentioned that there are concerns about both inventory buildup and supply chain disruption. The increase in finished goods inventory by $176.9 million raises questions about potential overstocking, while the balance of intra-entity profits on inventory purchased from equity method investments suggests a possible issue with supply chain management. Furthermore, pages 32 and 39 highlight additional challenges facing the company's supply chain. Shipping and raw material delays in the Middle East, coupled with increased shipping and fuel costs due to rising prices, indicate potential disruptions in the supply chain. The significant decrease in cash and cash equivalents on page 39 primarily driven by increased inventory balances and lower accrued expenses, also suggests that the company is struggling to manage its working capital effectively. Overall, these concerns suggest that the company's inventory management and supply chain operations are facing significant challenges, which could have long-term implications for the business. That concludes the financial summary for Albemarle Corporation. Feel free to comment below, and I will be happy to answer them when possible.